how do you revitalise New Zealand capital markets? And you go through some of the investment houses, and they've been putting out articles one way or another, sometimes disguised, but asking those very same questions. Right? How does New Zealand capital markets actually get a shot in the arm?
Given that, there's a fair amount of New Zealand beef that goes into the US, and I'm pretty sure a fair amount of that probably goes into McDonald's burgers, given Trump's interest in the Golden Arches, maybe there's a trade opportunity for us there.
Cryptocurrencies now have an investment legitimacy which will not be broken, notwithstanding what happens. Right? And it will speed up moves by central banks and other mainstream financial service providers to get into the space somehow.
Kia ora and welcome to Shared Lunch, brought to you by Sharesies. My name is Helen Mattison, and today on the program we'll be looking back at 2024, the good, the bad and the ugly. But we'll also be looking towards 2025 and what's in store. I'll be joined by Gyles Beckford, the business editor at RNZ, and Infometrics Chief Economist, Brad Olsen. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Thanks for coming in, Gyles and Brad. Welcome to the studio and our last episode of Shared Lunch for 2024. Let's start with January this year, when the Security and Exchange Commission, that's the US regulator, actually approved Bitcoin exchange-traded funds. That's a real difference for crypto and probably legitimises the fact that it could be an asset class. Gyles, how do you think things have fared since then?
Well, that was the good housekeeping seal of approval, wasn't it, when the SEC comes out and says, it's got a future, and everybody figured, let's not play around with actually getting into the crypto. Let's get into the crypto operators, hence the ETFs that got set up. And bang, that was just the touching the blue paper, and away it went. And all we've seen since then is just a complete appreciation, right? It's dominated by Bitcoin. You have to say that there's much about the crypto scene which is still dodgy, it is questionable. You just know that there's so much dark stuff happening under the surface. And the amount of crypto that's been stolen, so much for it being a necessarily secure investment. But all that aside, once the bandwagon gets rolling, everybody keeps chasing the train, and that's what's happening. And with the prospect now, with the new Trump administration saying, we're going to make it easier, when you've got the likes of Musk being able to hype it up, in particular Doge, how coincidental is it that the new department he's going to run to take out the red tape and make government more efficient and cheaper and easier has the acronym Doge as well.
It's a complete meme, right?
Exactly.
It really is.
Right, and they're not going to have the US government seal there. What they're going to have, in fact, is probably the portrait of Elon Musk, right, behind every employee there. But you have to say that cryptocurrencies now have an investment legitimacy which will not be broken, notwithstanding what happens. Right? And it will speed up moves by central banks and other mainstream financial service providers to get into the space somehow.
I think as well, though, yes, it legitimised it a touch, but I think it also gave it crypto more generally a bit of an easier entry method in, rather than people having to figure out how their own wallets and everything else worked. You didn't have to go through all the hoopla that was sometimes either a bit dangerous, dodgy or otherwise, and it actually just made it a little bit more convenient through those ETFs and similar. There's still, I think, like you say, a lot of caution, a lot of worry in some areas about it, and people are still dropping new coins all the time, and there was another popular one the other day, the Hock Tour girl released a coin that shot up in price and then immediately crashed 90%. So again, some people are still putting some pretty serious money into things that they're not fully or aren't fully regulated, but now there's a little bit more of some guardrails around it that provides a little bit more legitimacy. You're right.
It'll be interesting to see actually how firm those guardrails are, because the US will set the standard for regulation.
And everyone else is going to take it, right?
Around the world. What I like about one of the bigger operators here in New Zealand, and we've spoken to them a few times recently, they, I think, are probably being extremely responsible by saying, look, do your due diligence, right? But don't take this as being the be-all and end-all of your investment future. This firm, whom I won't name, but they're saying, look, regard crypto as, say, a 5% part of a diversified portfolio, right? And just be sensible, right? And I'm thinking, these are people who are actually going to earn money out of it, but they're taking a really responsible view, trying to advise people and keep the custom.
Well, that's with everything though, right? I mean, the risk conversation is always the biggest one. I still all the time, all through this year, all through the last couple, have people coming up, and there are generally three questions that people on the street want to know. They, what's the housing market going to do? What's my personal interest rate that I should fix on for? And what's my investment strategy? And I always go back, well, what's your risk tolerance? If you're real happy to sort of maybe put it all on one thing and it'll either blow up or blow down, as the case might be, then that's cool for you if you're willing to lose it all or gain it all. But for a lot of other people who aren't, it's then going, well, how do I sort of match things through? So you're totally right. That's a much more appropriate response than sort of plough it all in on the one option and sort of hope like heck it works.
Sticking with the US, guys, I'm just thinking Donald Trump, president-elect, tariffs has been a big topic, and what will happen to New Zealand and other countries. Uncertainty seems to be what we're going for in 2025. Brad, what are you thinking, given the US is our second largest trading partner?
Yeah, well, and that's only happened this year, right? The Chinese economy hasn't been going as well. We've now been doing more with the US because their economy has been a lot stronger. That's great, but equally, you're right that we're seeing more uncertain times, but perhaps we're seeing more certain uncertainty. You know it's going to be maybe not as volatile, but there's just so many moving parts that are sort of heading forward. So I think increasingly when we're looking at the US markets and more generally the US economy, I think we know that we're in for quite a lot. You saw some of those early talks this year by Trump saying, look, I might levy tariffs on Mexico, Canada and China. Now, we knew about China. We didn't necessarily know who was going to be first off the ranks for the other ones. But again, the reaction that had, one, changed the currency around quite a bit for New Zealand, but also some of our providers like Fisher and Paykel, they've got manufacturing sites in Mexico that supply North America. So I think it also highlighted to us again sort of the importance in the financial system that the US occupies. We've known that for a long time, but it's been a bit more latent or background, and now all of a sudden it's back to the forefront, because whatever happens there will have sort of ripple effects, and maybe bigger ripples than before, through to the rest of us.
I think Trump's last administration is slightly indicative of how we might feel the whole thing about tariffs and the like. The one thing that sort of directly affected us, and it was only small fry, was aluminium and steel, which the tariffs cost us somewhere in the region of, say, $6 million, I think, over that period. But the bigger impact, in fact, was the paralysis that attached and Trump brought to the World Trade Organization. Now, we believe in the World Trade Organization because it's the referee of the world trading system. It's rules-based, and little people like this, when you haven't got financial clout, right, you've got to rely on the rules to help you. And the Trump administration last time round, they basically froze the WTO into inactivity. They made it impotent, right, as a trade referee, very simply just because they refused to nominate people to be appellate judges, right, to work out the disputes between people, trying to work out. What's interesting for me is it sheds a bit of a light that there are a significant number of small New Zealand tech companies who have domiciled themselves essentially in the States. Right? And that might be our little secret back door, right? That we've got Kiwi firms doing business in the States who will actually be, to some extent, insulated, right? They actually might get the advantage of these sorts of things. But we'll wait and see on that one. Right, Trump, look, there's more bluff and bluster, right, than you would find at Niagara Falls.
Well, you just don't know, and I think that's one of the big challenges for everyone, not only New Zealand but around the world, is you're just not sure what is ever going to necessarily come through. I mean, the wider tone, I think, from this is that trade is going to be more difficult, which is not great news for New Zealand. Equally, I've been quite impressed that this year, we have had a greater focus on trade deals. We've got ones with the UAE, we've got trade deals with the Gulf Cooperation Council, we've got some with Costa Rica and Switzerland recently. So there's still a lot of good moves there. We've had in the last couple of years both the EU and the UK free trade agreement. So we've still got a lot of options out there, but I think that trading environment is more difficult. The challenge, I think, is that the US economy is still such a hefty part of the global market that, this year, for example, we saw that when our meat wasn't going as well into China, we could pivot that quite quickly, a lot of it, not all of it, but a lot of it into the US because they've got the lowest beef stocks in, I think, 70 years. So, that's where we can send our meat. Now, it does always come through, and we've talked about not only the tariffs, but the possible exemptions that maybe we need to try and focus on, because Trump won't be looking to target New Zealand. It'll just be probably an across-the-board thing. But given that, there's a fair amount of New Zealand beef that goes into the US, and I'm pretty sure a fair amount of that probably goes into McDonald's burgers. Given Trump's interest in the Golden Arches, maybe there's a trade opportunity for us there, or some sort of exemption. But I mean, just the consumption numbers that you're seeing in the US, they are spending like no tomorrow. And I must say, looking at the markets as well, there's part of me that goes, where to next? I mean, what's going on there?
I'm keen to see what you think of that, Gyles, too, because the tech stocks, Nvidia and the like, it's been insane, but there seems to be no bottom.
Well, I don't know. Let's be honest. Things can run their course. We've been through these sorts of cycles in the past. I'm thinking, look, I've been around so long, right? The internet wasn't invented when I started journalism. Right? Microsoft was just a twinkle in Bill Gates' eye. But what then turned out was that we very quickly, had the dot-com bubble. Bang, right? Just on the turn, the late 90s, right? We had the e-commerce likes, right? Everybody built so much promise into it, right? Bang, it fell away. But I think, we've got to say that the tech stocks now, they have such clout. When the likes of Nvidia is 100 times bigger than the New Zealand economy, I think is the valuation of it, something like that, you go, yeah, they're probably here to stay. It's the games that the investment funds want to play, I think, and where the technology will take us, where we see that artificial intelligence will be the driver for 2, 3, 4, 5 years, right? The Nvidias of this world and all the other chip makers and the associated tech companies must continue to thrive. The Magnificent Seven, who knows if they'll actually be 7 or 17 or 3.
Or the same companies.
Or the same companies. Yeah. And who will own them. I mean, politics comes into play because there's a lot of Chinese influence in that tech sector, like it or not. And do the politics of a Trump administration want to punish the Chinese, as we've just actually seen in the past few days, where there's a district court judgment in the States, right, that TikTok's got to be divested. And so from that point of view, technology's here to stay. There will all be companies and money that drive that. We're going to see more boom, I think, but I think we just got to say there will be bust somewhere as well.
Well, it has been interesting. I saw a chart the other day that, because let's be clear, this is mostly about the US markets. It's not that generally, stocks and equities and that are just on a rocket ship to the moon. It's the US. And I saw something the other day, I think, that said that, the US markets are, now so far away relative to Europe. It's like the biggest the gap's ever been in terms of sort of, the positioning on the US compared to Europe. And I went, that does highlight that, again, there's a lot of growth in fundamentals. There's a lot of money going in there, there's a lot of consumer spending. But I go, the markets are high when interest rates have been high. If interest rates then come down, normally that would stimulate a greater level of investment and spending, which would then put the markets higher. So if the markets are high when interest rates are high and when they're low, then like you say, I mean, my question is, when does it turn around? But I mean, the reality is, you look at the sorts of numbers that New Zealanders invest, we do put it into the US as well. We're not alone in that fact. So there seems to be, correct me if I'm wrong, Helen, but there seems to be sort of quite a focus there on people wanting to look at it.
What I find interesting, though, is that you talk about how the US is just, well ahead of the rest of the world, right? Is that it also introduces distortion into capital allocation around the world. And you've got to say, well, if the US is sucking it all up or is putting most of its own resources into this sector, right, how's the rest of the world going?
Yeah, where's the rest of it?
That's right. Where's our bit? Right?
Well, that leads me to the fact that here in New Zealand, we've had our highest trading days ever at Sharesies. A lot of that is US fueled because everybody sees great returns, prospects, etc. They're not seeing the same with our own market, the NZX. And Gyles, there's been a few shockers in terms of earnings. There's many companies I could talk about, Sparky in New Zealand, the Warehouse, the list goes on. Yeah.
Look, it's the incredible shrinking NZX, isn't it? You contrast it with 30, 40 years ago, where it was well driven, well supported. But the NZX, you have to say, has just not been able to make any headway in persuading local companies that the exchange is the place for them. What is the NZX for? Essentially, it's a way of raising money. Why do you invest in it? Well, because you as an investor have confidence in the way companies are run. You would have to say that over the past 2 to 3 years in particular, and in the case for some companies for the past decade, they've been less than competently run, right? And I was tallying up the number of companies in this country that have not been paying dividends for the past couple of years. There's some really big ones, right? Sky City, Fletcher Building in New Zealand, some of the retail stocks, right? They're all saying, we're saving our cash. Well, saving their cash for what? Well, saving their cash actually to cover some rather big holes in their balance sheets because they made really bad decisions. And I think that's one of the features is that the level of corporate governance and commercial nous that's been applied by some of our publicly listed companies has been shown to be woefully inadequate. Leave aside the one-off effects of the pandemic, because everybody got a kick in the backside and a kick in the balance sheet for that. Well and good. But you have to say that the level of shareholder return, and the New Zealand market is essentially supported by investors who want dividends. That's what it's all about. It tells you everything that the NZX 50, the benchmark index, includes dividends, right? A lot of other places around the world, it doesn't. And I think that a lot of people will have been woefully disappointed, and you can see why people don't have much enthusiasm for actually getting in there. If there's going to be a big IPO, say, let's just pretend Kiwibank. Kiwibank, gosh, aren't they just the spectral vision on the horizon now that is going to save us all? Kiwibank.
Are they?
No. But the point being is that, say Kiwibank were to list, everybody would be in, like the way that people were in for the gentailers, right? Meridian, Mighty River Power.
But we're talking 2028, aren't we now, Gyles?
Well,
if it happens at all.
It may not happen in any of our investing lifetimes.
Geez, that's grim. I've got a lot of time, I think.
Right. But I mean, I think serious questions come down to how do you revitalise New Zealand capital markets? And you go through some of the investment houses, and they've been putting out articles one way or another, sometimes disguised, but asking those very same questions. Right? How does New Zealand capital markets actually get a shot in the arm? And I'm not sure that anybody's actually got a reasonable answer about that.
Well, the question I start to ask is, when does this come to a head? Because you've got the issues we've just canvassed. The fact that increasingly there seems to be a trend of businesses that are either looking to only list on the Australian markets and Australian exchange, or they're actually going unlisted here in New Zealand because they don't want all the big obligations and the costs and similar. So I think one of the reasons that you're not seeing, for example, as many young people, I know that there's an easier way to vote now, and I've done that myself with my Sharesies app, but I look at that and I do find that a lot of times people go, well, I've continued to get the same results, and I feel like it's not like I can put up a director or anything else. I've sort of got to vote on the pitches that are made by those that sort of seem to have more of the power, what's the point? I'm sort of just voting for the same old, same old. So I think there is a real lack of engagement and a real level of disappointment amongst investors, but who are voting with their wallets and going, well, stuff it, I'll find something better. And they are.
Yeah, the one little candle of confidence, if I can call it that, is that I like the more assertive and prominent attitude that the Shareholders Association has taken in the past few years, where they've been willing to stand up, whether it's big company or small company, and saying what you're proposing isn't good. It works against the interests of small shareholders. And let's be honest, the Shareholders Association looks after little folk like me who've got their 300 shares in abc.com, and we feel the person who's got 10 million shares, right? Well, we're done, so why bother? But we got some sort of return. But the Shareholders Association says no. Big company or small company, say you've got a standard of care and a standard of duty and a fiscal, a fiduciary, and legal obligation to look after all shareholders, big or small. Right? So I applaud the Shareholders Association. I actually think that if there was an organisation to belong to as an investor, that would be one that you would look at and say, it's worth giving our support, because if somebody's going to be a voice against some of the bigger powers, it'll be them.
There's been a bit more sort of talk as well, I feel, this year and last as well, about sort of putting your money where your mouth is, making sure that for some of those people who are on boards and even in management, that they need to have some skin in the game to recognise why this loss of value and the lack of outcome is actually important. And I mean, you brought up Kiwibank, and I sort of feel like that's sort of similar there. I find it pretty difficult to stomach the idea that the government thinks that having a bank is so good, but it's not good enough for them to bank with. Why on earth does a government own a bank that they're not willing to do work with?
Speaking of banks, and one of the things that did happen in 2024 is interest rates, which obviously banks have a big part in play in. Thinking, Brad, we're on the downward cycle, but it doesn't feel like it's champagne time. It's caution still. What's your view on where we're going to get to in 2025?
I think the big thing with interest rates at the moment is we're looking for where the new Goldilocks zone is. Where is the new normal? Because it might not be exactly where it was pre-pandemic in 2019. And I think the difference as well this time is we're not trying to stimulate the economy. We're trying to take our foot off the brake and stop restraining it. If you look at where the official cash rate is expected to end out, around that sort of 3-ish%, maybe 3.5%, that's still quite a bit above where it was in 2019. So I think that's the sort of the different tone. We're trying to unlock the economy, but we're not trying to put any sort of boost or NOS behind it. We're just trying to get it back to a normal solid level of operation. So that will be different. I think when we're looking at sort of the next year, there's been a lot more front loading of those interest rate cuts by the Reserve Bank, and there seems to be a bit more front loading that the retail banks have done as well on mortgage rates and the likes of savings rates and similar as well. So I do wonder, there will be further cuts next year. There will be more to come, but I think that we're possibly closer to the bottom of interest rates than we might think. It's just that it will take a while, I think, for households to refix. So there's probably another 6 months of quite challenging conditions until mid-year, when a lot more people have refixed. They've all of a sudden got a bit more money that they're not spending on the mortgage. They can spend that on other things. Business sales start to perk up a bit. Businesses then need a bit more resource, start to hire a bit more, and you start to get, again, that more, I guess it is, solid level of economic activity. It's not economic doldrums, but it's not the rocket ship to the moon stuff either.
Interestingly, just before I came here this morning, one of our leading clothing retailers just reported to the NZX saying our sales are up 10% for the first 18 weeks of our trading year. And go, 10%, that's great. And they said, but you should have seen what they were like last year. So a 10% rise, isn't that great? But they made the comment that they found that their margins were actually stable in an environment where everybody else would be doing deep discounting just to get goods out the door, right, and to get cash into the tills.
That turnover piece.
That whole turnover piece, right, just running fast to stay still. And from that point of view, there's been a real pressure on margins. In the end, I think a lot of firms were hanging on by their fingertips through the pandemic. They were saved by wage subsidies and other cheap finance schemes that came through from the government. And now that tap's been largely turned off, right? And people like Treasury and the banks are saying, well, we lent you, $500,000 during the pandemic. Excuse us, can we have some of it back, right? In an environment where they're still paying high money for their working cash when they're not making sales. And wage bills have actually, we should note there that their wage costs have gone up quite considerably as well.
So looking at that,
Throw it all together,
yeah,
you can see why more businesses are failing.
And we probably will have some more failures, you think?
Oh, bound to. I mean, you've got, 436,000 people, I think, by the last NZX report were in their debt arrears, right? 436. Now, you'd say, that's enormous. The number of liquidations of companies is double in the past year or so, right? In particular, construction, retail doing it really hard, and hospo.
It is interesting though, because I feel like we're sort of back into almost an economic purgatory position where you've got those business closures coming through. You've still got some pretty tough operating conditions through in the economy, but at the same time, you are looking at the likes of electronic card data is starting to pick up ever so slightly. It's still down on a year ago, but it's picking up slightly, and I think it highlights that there's still that level of caution amongst consumers that when we've looked at that, how that spending has sort of changed. Consumables, so your supermarket spend, your essentials is pretty stable and solid. Your durables, your big items, your electronics and couches, and that's still pretty lackluster.
One of the other features of 2024 was we had the introduction of climate reporting, and that's for entities, I think, that have got 1 billion in assets. It feels quite mixed, the reaction we've had. What would you say, Gyles?
Well, we had two big reports out in the past couple of weeks. One was from the Financial Markets Authority, who have got the oversight for the climate reporting entities, those big firms that you were talking about. They said, well, generally speaking, people have sort of got to grips with it, but there are areas of need for improvement. And we got the view that some firms actually probably still haven't quite got to grips with what they're supposed to say and what they're supposed to measure and how they're supposed to present the information. Some of them were accentuating the positive, right? And should we say...
Do you mean greenwashing?
Well, the dirty word, but exactly, they were greenwashing. And then there was a report by Forsyth Barr, who looked at those companies on the NZX who were putting out their ESG reporting, and they do a carbon component as well. And they said the ones who have got to grips with it are the gentailers. And the reason why, of course, is because they've got some of the biggest carbon emissions. So they actually, they measure, they know the cost, they're moving to mitigate various things. They've got the whole renewable energy side to their business as well. They're fine. Other companies are trailing quite a way back. Everybody's making an effort, right? I thought the interesting comment that came out of the FMA report was that cost of compliance, even for a small firm, a smallish firm, you can be spending $1 million or more to actually do this report or to do these reports. It's required by law for those entities who have been who meet that criteria. But and it's taking up a lot of time. There's a whole industry now in ESG reporting. So all those firms that were doing consultancy on smart tax tax minimization schemes, right, are now doing reports on how to do your ESG reporting. That's a new side of their business.
See, that's my worry as well, though, is that we're effectively creating a whole another cottage industry. And in fact, you get some of the businesses who, I don't know if it's been publicly reported, but a few every now and then seem to suggest that actually they're spending more on compliance, that they've actually had to strip out some of their budget for doing stuff on the climate, for supporting, their adaptation and mitigation, to just fill out the forms and do some of that reporting. And that seems a little bit over the top. There has been, I think, some common sense changes that have come through from the External Reporting Board and that have sort of pushed out the expectations of how quickly a whole lot of the additional reporting has to come through, and that's important. And my sort of worry is, I totally think we need to do this. Quite clearly, it's important. More importantly, from a business point of view, you're seeing a lot of our overseas operators, those who are buying from New Zealand businesses, saying, I need you to do this, otherwise I won't buy from you. So there's a business imperative there for it. But I feel like there's got to be a slightly smarter way of of going about it than making everyone do all of this paperwork that might have some value but maybe isn't all going as easily to plan, isn't quite as cheap to produce, and more importantly diverts resources away. There's got to be a better middle ground there. It was encouraging though, at least what my sort of one positive on that broader climate landscape was at least the emissions trading scheme got a few credits sold this year, because
the carbon markets.
I mean, there was nothing beforehand. Again, still not working like it should be, but the fact that there was actually a few, bit of a look up.
You wouldn't like to buy some cheap carbon credits, would you? I've just got a few thousand.
Look, if I could buy some, I probably would. I mean, one of the disappointing things this year, as an economist, we're always looking at numbers, was that actually some of the transparency on the carbon markets was taken away when Jardins closed the sort of public fronting on carbon price reporting. So, I mean, it's one of those things, I feel like the government's still got a lot of work to do there to make everyone actually realise that you do need to do this stuff, rather than at the moment, it still seems like everyone's yeah, okay, we get it, but you don't seem committed, so I don't know if I need to be committed yet, which is a bad place.
Interestingly, of course, the government, before it came into power, was counting on a rather robust ETS to be able to furnish some money for them, which actually hasn't emerged. Right?
There's no money in the kitty from that.
Right, yet another pressure on the fiscals.
Now, guys, we've talked about a lot of things, and a lot of them are a little bit depressing. We need to lift the tempo somewhat. What are you thinking in 2025, I'll start with you, Gyles, is going to be a positive for New Zealand?
Oh, I think we're just actually going to be more cheerful. I mean, we are. I mean, and that's...
that's where it starts. It's that positivity there.
Right. I mean, a sunny disposition, all right, even if the weather doesn't play ball. But I think people... You're feeling it already, right? People talk positive, right? I mean, the number of people I talk to now are actually saying it won't be thrive, right? But we've survived, right?
Brad?
Yeah, well and good.
You're right. Next year, I think, will be better, quite simply because people's mortgages are coming down. Like that, we've seen that effect. Monetary policy did very well to curb economic activity when they were high. Now they're coming down. It will give people a bit more money. So I think as we go through next year, it won't hit the 1st of January, everything is all that quickly better. But that sort of talk around, green shoots, and I've been talking about it quite a lot. I feel like the sunflower comes out a bit more around mid-year, if you will, because that's when the spending will come through. And again, I mean, you can't break the economy down this simply, but sometimes you have to try. Once households are spending a bit more, they will go and put that out into businesses and similar. Those businesses, once they have a bit more activity, they've got some runs on the board, they need a few more people to work through that. That then stimulates a bit more employment, the unemployment rate drops, a bit more spending happens. So again, I think you're right, we're just onto a more solid footing next year.
Speaking of spending then, Brad, what are you thinking for spending for Christmas? What about gifting? How do you feel about that?
Personally, I really struggle with present shopping. It's just the crowd sort of, I struggle with those enough. But as a good economist, the sort of lowest transaction value is to give people cash. In fact, a bank transfer would be better. Now, some people say that's very unsentimental. Gyles, I don't know if you've got a view on how you gift, but I'm a big fan of cash and money. That's a much better option for me. Very easy. Whoever I'm gifting it to, they can choose whatever they want.
The best gift I think I can give actually is my time, right, is to be actually with, you can't put a price on it other than to say, right, when I have a family gathering, I come away uplifted, right, and I hope that, they gain a little something from me. And so time is the most important thing. And I don't think, look, we speak about peace on earth, goodwill to all people, right, for Christmas. Why don't we do it for 365 days of the year? Actually, that's the key issue. I know it doesn't generate a lot of money, right? I know, Brad's economic fillip won't, necessarily get that boost, but so be it, right? If we're actually better mentally and within our own family structures, that actually to me is the foundation of a good economy.
Well, there's many more things we could talk about, guys. Thank you so much for coming in today and being with us for our last episode of the year. And thanks, listeners, for joining us. You can watch Shared Lunch on YouTube, or you can follow us on your favourite podcast app. Leave us a rating and tell us what you'd like to hear next. Merry Christmas and mā te wā.